Maybe you plan on using debt consolidation if you have some loans now. I hope the following can help. Debt consolidation is a financial strategy that involves combining multiple debts into a single loan or payment. This can simplify debt management, potentially lower interest rates, and reduce monthly payments, making it easier to pay off debt over time. How debt consolidation works: 1. Single payment. Instead of juggling multiple payments to various creditors, you make one payment to a single lender. 2. Potentially lower interest rates. By consolidating high-interest debts, such as credit card debt, into a loan with a lower interest rate, you can save money on interest over time. 3. Fixed payment schedule. Consolidation loans typically have a fixed payment schedule, which can help with budgeting and financial planning. Here are the methods of debt consolidation. 1. Debt consolidation loans. Personal loans. Unsecured loans from banks, credit unions, or online lenders used to pay off multiple debts. An example. You have 3 credit cards with a total debt of $15,000 at an average interest rate of 20%. You take out a personal loan for $15,000 at an interest rate of 10% to pay off the credit cards. Now, you only have one loan to pay off with a lower interest rate. 2. Balance transfer credit cards. 0% APR balance transfer. Transfer existing credit card balances to a new card with a 0% introductory APR period. Example, you transfer $5,000 of credit card debt to a new card offering 0% APR for 18 months. You pay off the debt within that period without incurring additional interest. 3. Home equity loans or lines of credit, HELOC. Secured loans. Use the equity in your home as collateral to consolidate debt. Example, you take out a home equity loan of $30,000 at a 5% interest rate to pay off high-interest debts. This can be risky, as failing to pay could result in losing your home. 4. Debt management plans, DMPs. Credit counseling agencies. Work with an agency that negotiates with creditors to reduce interest rates and consolidate payments. Example, a credit counseling agency helps you consolidate $20,000 in various debts into a single payment plan with reduced interest, which you pay over 4 to 5 years. Here are the steps to use debt consolidation. 1. Assess your debt situation. Calculate your total debt, interest rates, and monthly payments. 2. Review credit score. Your credit score impacts the terms you can get on a consolidation loan. 3. Explore options. Research different types of consolidation loans or methods, compare interest rates, fees, and terms. 4. Apply for a loan or plan. Apply for the chosen debt consolidation method. 5. Pay off debts. Use the consolidation loan to pay off your existing debts. 6. Repay the consolidation loan. Make regular payments on your new consolidation loan or plan. Benefits of debt consolidation. A. Simplified payments. Managing a single payment is easier than multiple payments. B. Lower interest rates. Can save money on interest, especially if consolidating high-interest credit card debt. C. Fixed payment schedule. Helps with budgeting and financial planning. D. Improved credit score. Timely payments on a consolidation loan can improve your credit score over time. Potential drawbacks. A. Origination fees. Some loans have fees that can add to the cost. B. Risk of higher total cost. If the consolidation loan has a long term, you might pay more in interest over time. C. Collateral risk. Secured loans, like home equity loans, put your assets at risk if you default. D. Not a cure-all. Doesn't address the underlying issues that led to debt. Other examples. Sample 1. Personal loan. Sarah has 3 credit card debts, $5,000 at 18%, $3,000 at 20%, and $2,000 at 22%. She consolidates them with a personal loan of $10,000 at 12% interest. Her new monthly payment is lower, and she saves on interest. Sample 2. Balance transfer card. John has $8,000 in credit card debt. He gets a balance transfer card with 0% APR for 15 months. He plans his budget to pay off the debt within the introductory period, avoiding interest altogether. Sample 3. HELOC. Emily has $25,000 in various debts. She uses a home equity line of credit with a 4% interest rate to consolidate her debts. While this lowers her interest rate and monthly payments, she is careful to make timely payments to avoid risking her home. Debt consolidation can be a useful tool for managing and reducing debt, but it's important to choose the right method. And maintain disciplined financial habits. Spending money has become easier than ever, with just a few taps on the screen in seconds. Use your money well. Thanks for watching. If this helps, kindly like, share and subscribe also for more videos. Cheers.